Group statements, value adjustments. The effect of value adjustments on the consolidation process where you deal with depreciable property, plant and equipment. Example B. At acquisition date 1 January 2010, the identifiable assets and liabilities of S Limited, the subsidiary, were considered to be fairly valued in terms of IFRS 3 business combinations except for the equipment. The carrying amount of the equipment in the trial balance of S Limited on this date is 480,000. The fair value is, however, 520,000. The remaining useful life of the equipment on 1 January 2010 is 10 years. S Limited accounts for the equipment in terms of the cost model of IAS 16 property, plant and equipment. There is therefore a fair value adjustment or a revaluation surplus necessary at acquisition date regarding this equipment. Because S accounts for the equipment in terms of the cost model, S will not account for this value adjustment in his separate financial statements. On 1 January 2013, S sold this equipment for 370,000 Rand to an external party. The financial reporting date is 31 December, and we will consolidate now on 31 December 2013. The work method that we follow is to identify the items recognized in S, so separate financial statements regarding this equipment. We need to identify what we want these balances to be in the group statements, and wherever differences are identified, it will lead to consolidation journal entries. The main reason why we have differences in this situation is because S didn't account for this revaluation of the equipment in his separate financial statements at acquisition date. You now identify all differences since acquisition date regarding this equipment. The carrying amount of the equipment in S is 480,000. The fair value is, however, 520,000. So at acquisition date, we had a 40,000 difference that had to be accounted for. Since acquisition date, there was a depreciation charge for X10, X11, and X12 in S's separate financial statements to the value of 48,000. In the group statements, it has to be 52,000 for each of those 3 years. That led to a difference of 4,000 additional depreciation per year for the previous 3 financial years. The carrying amount of this equipment on 1 January 2013 is therefore 336,000 in S's separate financial statements. The carrying amount should, however, be 364,000 in the group statements. On this date, 1 January 2013, S sold the equipment to an external party for the value of 370,000 Rand being the proceeds. That proceeds was received in the bank account of S and is also the proceeds applicable for group statement purposes as it was received from a third party. In S's separate financial statements, the carrying amount of 336 sold for 370,000 led to a profit on sale of 34,000 recognized in the separate financial statements of S. In the group statements, the carrying amount, however, is 364,000. Therefore, for group statement purposes, there should only be a profit of 6,000 recognized on the sale of this equipment. So the 34,000 profit on sale in S's separate financial statements will have to be adjusted in the group financial statements to only be 6,000. All these differences identified will now lead to consolidation journal entries. The first journal entry that you will always have to recognize in a scenario like this is the following: a credit to your revaluation surplus at acquisition date. The reason for that is because S did not account for this revaluation in his separate financial statements at acquisition date. So for as long as this group is being consolidated, this credit to revaluation surplus at acquisition will have to be recognized. That increases the equity of the subsidiary at acquisition date, which will be eliminated in your at acquisition elimination journal entry. Without this credit, it's not available to eliminate, and that could lead to incorrect goodwill in the group financial statements. The question to ask now is, what are the other items included in the separate financial statements of S that's different from what I wanted to be in the group statements so that we can adjust them? The main thing to notice in this example is that the equipment has been sold. So you cannot have a consolidation journal entry changing the carrying amount of the equipment anymore. The equipment no longer exists in S or in the group. The first entry to adjust would be a debit to your retained earnings opening balance for the previous 3 years additional depreciation charge of 4,000 Rand each. For the previous 3 years, S's depreciation was annually changed with an additional 4,000 Rand in the group. In X13, the effect of the previous 3 years additional depreciation expense is reflected as a debit to the current year retained earnings opening balance of the subsidiary. The other item identified as being different from what we wanted to be was the profit on sale. So the profit on sale of asset in S is 34,000, which represents a credit entry. That 34,000 credit must only be a 6,000 credit in the group. So to change a 34 credit to be a 6,000 credit, you need a debit for 28,000, and the line item that's changed is the profit on sale in profit or loss of S, 28,000. If we have to repeat the effect of this consolidation journal entry in X14, it would be as follows. Again, you would first credit the revaluation surplus at acquisition for 40,000. Now, you can no longer debit profit on sale of S because in X14, that profit on sale is included in the retained earnings opening balance of S. So your other consolidation entry leg would be debit retained earnings opening balance of S, and now it would be for the 40,000, which is the 12,000 additional depreciation for the previous 3 years, plus the prior year profit on sale adjustment of 28,000.